All right. Well, we're going to get started. We'll have people join in along the way. So definitely want to allow for a time at the end for questions. Right now, if you can please, I think I have everyone muted, but make sure that you're muted. And we'll go through some of the details we want to go through. Amy and I will. And then we're going to open it up for questions. Also, I mean, if you want, the easiest thing would be to unmute at the end and ask a question. But if you want to chat it, type it in the chat. We can read it out and answer it that way, because I'm sure that many of your questions will be something that somebody else would have wanted to ask also. Okay. So really to start off, I mean, the condos have been going through a lot of changes over the last year and a half. The main changes have been as a result of that condo collapse in Miami. That definitely threw up some alarms that, hey, wait a minute, we're reviewing condos and approving them. And we're talking about us as the lender for Fannie Mae and Freddie Mac, also FHA and VA, but we're limiting this call to just conventional mortgages. But we never really asked any questions about the maintenance of the building, any projects they have coming up. There was no discussion of that. Basically, we were evaluating their budget. We were evaluating their insurance coverages. We were evaluating their ownership percentages and basic things about the HOA, but nothing to do with the actual structure and the buildings and the maintenance piece. So as a result of that collapse, that raised some big concerns that we've got to dig deeper, because the liabilities involved with that, and making sure that as a buyer purchases in these complexes, they're not putting themselves into a building that, they could walk out on their patio and it could collapse on them, right? So these new guidelines went into effect after that in 2021, I believe, Amy, it was, and they just became permanent in September of this year. So a couple of the important things to know here is that, we have a special condo team. Amy Rome heads up that condo team. She runs our division approving these condo complexes. We are the largest condo lender in Chicagoland by far. We do more condo approvals than anyone else. We have an internal database that we maintain. And also Fannie Mae and Freddie Mac have databases of approval and complex approvals. Now, the one thing that is really important to know is that, as we work on a condo approval for you, for a buyer, we are looking at it from the aspect of, getting the information from the HOA, but we're always trying to educate an HOA or a management company. When we get that questionnaire back, and if there's any issues or something that does not meet the guidelines, we're definitely going to interact with the management company or the HOA and say, hey, these are the guidelines that need to be met, and try to counsel them and try to help them to get that HOA to comply with the guidelines or be able to fit within the guidelines. And that makes it approvable then for our borrowers, right? And we spend a lot of time doing that, and that's I think one of the greatest assets we have as a company is that our willingness not to just look at something and say, nope, sorry, doesn't work, loans denied. And I'm going to say that probably 25-30% of the condominiums, when we initially get the information from the HOA, it's not approvable under what they gave us. And sometimes it's just them not understanding how to answer the question, maybe, or understanding, how the breakdown of a budget should be. They have all the numbers, but maybe they just don't have them all in the right way, or they're not having the allocation set up correctly. So, we're definitely trying to educate them on that. Now, you as a real estate agent, the main thing here with this call is you're all going to list a condo at some point, right? And doing the due diligence up front when you're going to list a condo is huge, right? It's the most important thing that you can be doing is asking your seller, who's your HOA or management company? You need all the contact information. Do you have your current budget? Are there any special assessments going on now? Are there any special assessments they're talking about that are coming up? Have there been any discussions of any type of maintenance to the building? You need to know all these things going into it so that if there is a concern, you can reach out to us. We're able to get some information from you and able to evaluate it, even get it to our condominium team to review and give you an idea of what needs to be done before you get to the point where you get a contract, buyer applies with a lender, and now the building does not meet some sort of requirement, right? We have our own list of approved condominiums that we've internally approved, and that list covers the whole country, but specifically Chicagoland. So we're able to look them up internally. And then Fannie Mae and Freddie Mac also have their own lists. Now, really important thing that Amy let me know today as we were prepping for the call, for all the years before just recently here, Fannie Mae and Freddie Mac, when we issue an approval, we would issue it internally. And if let's say we went in and got a full condo project approval through Fannie Mae, and Amy will, add on to this, it was certainly in their information, and then we'd look up other ones and you could see that it was already approved, and it may have been with a different lender. But up until now, if a condo complex was denied, let's say because there's $100,000 special assessment because all the balconies are rotted and they pose a health and hazard risk, that information never made it into Fannie Mae or Freddie Mac's database. So, customer could go to a different lender, get information to that lender and potentially get an approval, even though we looked at it and said, hey, listen, this project is not approvable. Well, going forward, every bit of information when any lender in the country reviews an HOA, a condo complex, that information is entered into that database. So if one lender looks at it and analyzes it and determines that it's not approvable, it's going to show up as it's not approvable. Amy will add on to that. One of the, as she goes through this and can discuss, how you get something that maybe was on the list is denied off of that list, right? But just to kind of get a big tie bow on the beginning end here, this is more about trying to provide you information on what you should be looking for. Some of the things that, the misnomers about condo approval, but most importantly, setting you up that if you need something reviewed, something just doesn't seem right when you speak with the seller as you're about to list their property, we want to be a resource to you. We want to be that team that's going to help you gather all the information and get a pre-look so it's going to be okay. Most of them are going to be fine, but if they, tell you that all the porches are going to be replaced soon, that could be an issue, right? So I want to take a minute now and introduce Amy Ramon. She's the head of our condo department here. She's been reviewing condos forever. She put together the slide set here, is going to go through some of these details. And then again, we'll open it up for questions at the end, or you can type them in the chat, and we will review and answer all those questions at that point, okay? Amy?
Hi there. Thanks for having me. Happy to go over everything I know about condo in a short period of time. So maybe not everything, that I know, but I'm going to walk through the slides, and Dan, feel free to interject or ask questions as we go along. Remind me if there's anything that you'd like me to bring up. Oh, you're muted.
Sounds good. Yep, sounds good.
Okay. So take me to the first slide, Dan. You've got the presentation here.
Yeah, I have the presentation. So hold on one second here. There you go.
There you go. Okay, so I've put this slide together for best practices for realtors and loan officers. So go over a couple things that kind of what should we do step by step depending on the information that we have. So if you have a listing in a condo or a potential buyer purchasing a condo, the very minimum amount of information that we want to try and get up front is the legal project name of the association, and the actual project name is very important, city, state, and zip code. This will allow us to check those databases that Dan was just talking about, our internal condo database. Our internal condo database allows us to see what we've done historically at guaranteed rate companies. So we can see, have we reviewed the project in the past? And then if we have, what documentation do we have for the project? And what was the decision on that file? Who did we deliver the loan to? What type of review did we do? So that is a resource for us to get ahead of the project prior to origination. So if you have that information up front, we can start researching the project. That information also allows us to check those Fannie Mae and Freddie Mac lists. Fannie Mae publishes both an ineligible and an approved list. And it's important that we find this out as early in the process as possible. If a project appears on the list as Fannie Mae's list as ineligible or unavailable, we need to find out why. Is there a way that we can fix it? Is there additional documentation that we can obtain to see if we can submit it back over to Fannie Mae for a re-review? And it will allow us to consider our investor options. This also is very important because they have a decline list. As Dan was talking about, when a project has been identified as ineligible either by a lender and then Fannie Mae has been notified, or Fannie Mae has done the review themselves and determined the project ineligible, that loan is not deliverable to Fannie Mae if it's ineligible. Like, we cannot take it to Fannie Mae unless we get the status updated or additional documentation to allow them to change their decision. And then Freddie Mac also is currently trying to build an approved list and a denied list. Guaranteed Rate is one of the organizations that have been selected to assist Freddie Mac in this process. So we're working very close with Freddie Mac to provide them with the documentation and the information about projects that we've either found approved and compliant with guidelines, or we found have issues and they need to put it on a decline list. So let's start with the association name, city, state, zip code. That'll allow us to at least get started and start some of that research. In order to provide more specific guidance or eligibility decisions, we're going to need as much information about the project as possible up front. Sorry, my phone did a little hiccup. I apologize. Some of the documents that we're going to need up front, the most important ones, are going to be condo questionnaire. It doesn't have to be the guaranteed rate questionnaire. It just needs to be a questionnaire. It could be from another lender. It could be the Fannie Mae or Freddie Mac forms, but we need a questionnaire. It provides us up front a majority of the information about the composition of the project and really gives us an idea if there's any obstacles or hurdles that we need to overcome. Budget and financials, very important to have up front so that we know our loan options. Can we do full reviews, or do we only need to proceed with limited reviews? So it's going to determine how much money down that borrower is going to need to be able to qualify for a loan in that project. And then master insurance. I'm going to take a second and elaborate a little bit on master insurance because it is becoming very challenging today. Master insurance is important to have up front. I don't know if everyone is aware, but the cost for insurance is on the rise, not only personally for our own homes, but for the HOAs as well. And what we have found over the last year with insurance for HOAs is that they're trying to reduce costs. Some of the ways that the associations are attempting to reduce those costs are by increasing deductibles. Guidelines, investor guidelines, agency guidelines require a cap of 5% on their deductibles. And we are finding a ton of projects have reduced their insurance costs by increasing deductibles up to the standard right now. What we're seeing is 10%. Another issue with insurance that we're finding, I just looked at a project the other day that was on Fannie Mae's list as ineligible, unavailable. We couldn't deliver loans in there. The association's replacement cost value for their project insurance was $165 million. But the cost for insurance was so expensive that they reduced the amount of coverage to $50 million. When you have $165 million as your replacement cost value and only $50 million in coverage, you're severely underinsured and the project is ineligible. That's another way that they're reducing their costs for insurance. So master insurance, we want to see that up front. We want to take a look at it. We want to see what we got because it could be a deal breaker. So it's an important document to have. Any other documents that you can provide is great, be above and beyond these documents that are listed. So anything you can get your hands on. I'm sorry. Sorry, my dogs are going a little crazy.
Okay.
I apologize.
I didn't hear any dogs.
Sorry. Okay. They're going a little nuts in the background. That's inconvenient. I'm sorry. So any documentation that you can get up front, get it, right? In some areas, we can even obtain a 22.1 disclosure, right? Resale disclosure. Although it's not as high level as a condo questionnaire would be, it does provide us at least some information about the project. So worst case scenario, if we can get a resale disclosure, it kind of helps us get some information up front to kind of help us along what we're trying to achieve. Checking the list, checking to see if there's any issues that are just a red flag right up front. So if we could get that, we'll take a look at those too. A suggestion that we have on the underwriting side is, help the loan processing team get those documents as quickly in the process as possible. At Guaranteed Rate, we have a dedicated condo underwriting department, and then we have our credit underwriting department. And they're separate from each other. So we don't need an approved borrower to be able to determine if the project itself is eligible. So we can get the condo documents anytime throughout the loan process, including pre-qualifications. So if we have a project that we're interested in doing loans in, but we may not even have a borrower yet, let's get the docs. Let's get it pre-qualified, because then that's going to be easier going forward when we do have a potential buyer in that project. So we do offer pre-qualifications as an option if we can get those documents. But again, getting those documents as early as in the process as possible allows us to get in front of things. As Dan indicated, we provide a lot of education from our condo underwriting department to these homeowners associations. We've seen a lot of positive changes in the condo industry since these guidelines have been introduced. In 2021, after the condo collapse, Fannie Mae and Freddie Mac both published bulletins with temporary guidance as an immediate response to start getting the information that may have prevented that situation. Since 2022, we put those temporary guidelines were put in place. We have seen till now that they're permanent guidelines. The response has been tremendous. Associations are making more changes to their budgets to set aside funds to get in front of projects before they're deteriorated. And we do feel like it's on a positive path. Because the associations are responding very positively to this, we feel very strongly that there's going to be more eligible projects in the near future because they're addressing their concerns earlier rather than letting them become deferred. At this point, Dan, is there anything else you want me to touch on before I get into the critical repairs section?
No, at the bottom of the slide, it does reference FHA and VA. I mean, they have their own unique set of rules and guidelines. We know that the FHA list has been diminished to very few condos. The process of getting even a spot approval done is a little bit labor intensive. And what we're finding is that most HOAs, don't have a willingness to provide all the necessary documents up front to get these things back on an approved list. So that's a whole nother thing, but we do FHA and VA project approvals, spot approvals for FHA. I just got a VA approval on a condo complex that wasn't approved for a borrower. So we're able to do those also. But yeah, we can move into the deferred maintenance piece now, Amy.
Great. All right. So critical repairs, in the past, it was called deferred maintenance. The temporary guidance was deferred maintenance, special assessments, and code violations. On July 5th, Fannie Mae and Freddie Mac made these temporary guidelines permanent guidelines, and they've changed some of the language and changed some of the requirements. So now we refer to them more commonly as critical repairs. These new guidelines took effect for loan applications taken on or after September 18, 23. And some of the changes in the guidelines, I'm going to kind of go over here, is Fannie Mae and Freddie Mac in the past did not require us to obtain any type of inspection reports or engineers reports. Now they require it. And I want to make sure that it's understood that it's project level inspections, project level inspections, or structural or mechanical inspection reports or engineers reports that have been completed within the last 3 years are now part of the required documentation that are needed for agencies and most investors. We're required to get these documents and review them as the lender to determine if there's any critical repairs that are needed. So even if they don't upfront tell us that there's any concerns with critical repairs, but they have these inspection or engineers reports, we still need to see them. So that's a really big change. Fannie Mae and Freddie Mac have also redefined the term routine repairs. And that's always been a little bit of a gray area under those temporary guidelines because they didn't elaborate much about preventative work. We don't want to penalize associations that are doing what they need to do. So when a repair or a project that they're undertaking is preventative in nature or a part of normal capital replacements focused on keeping the project fully functioning and serviceable, we don't want to penalize them for that. And preventative or routine is, an example would be the roof. Roofs they have a life expectancy, and a roof has, say, a 30-year life expectancy. If an association levies a special assessment or is undertaking a roof replacement, and they're doing that prior to the roof failing, that's when we consider it a routine repair. It's preventative. The roof has not yet failed, therefore it's preventative. It becomes a critical repair when the component fails completely, or even partially. So if a roof is so deteriorated that it's experiencing leaks or any type of water intrusion, it's no longer considered a routine repair. That's going to be a critical repair. Another component of routine repairs, or what is considered routine repairs, is what the association can accomplish in the project's normal operating budget or through a special assessment. So they don't need to take loans for that, or special assessments are specific to the preventative item, not special assessments in an emergency situation. So if they can afford to pay for those repairs through their normal operating budget or through a specific special assessment that hasn't been levied on an emergency basis, that can also be part of what is considered routine repairs. Fannie Mae and Freddie Mac redefined the term critical repairs, which are ineligible unless repairs are 100% completed. Repairs and replacements that significantly impact the safety, soundness, structural integrity, or habitability of the project's buildings, or impact the unit values, financial viability, or marketability of the project. It's pretty much what they're looking for. With the update in the guidelines to Fannie Mae and Freddie Mac, they've given us some specific components that we need to look for. Material deficiencies, which left uncorrected, have a potential to result or contribute to critical element or system failure within 1 year. So material deficiency is applied to a lot of different things, but ultimately we're looking to see, has it failed? Is there any negative results from the failure of that component? So material deficiencies, any mold, water intrusion, or potentially damaging leaks in the project. This is probably the number one critical repair that we see. We see them on the documents, we see them in the meeting minutes, and we do see that it could be water intrusion from exterior elements failing. That could be concrete, siding, stucco, trim, tuck pointing is a big one. The mortar between the bricks and the joints deteriorate and water gets into the building. If there's evidence of that, we're going to have some problems. So we need to see if it's been inspected? Has an engineer come out to address how big of an impact that water infiltration has to the building? So we definitely need to investigate all of those components a little bit more thoroughly to make sure, is it a critical repair? Advanced physical deterioration. I think this is the vaguest of the components that the agencies has implemented, because advanced physical deterioration can be a number of things. Really, we're looking for the water intrusion or any big major improvement that's needed for structural components. And advanced physical deterioration comes into play when we're reviewing the documentation. Usually an engineer's report will comment on advanced physical deterioration. Any project that failed to pass state, county, or other jurisdictional mandatory inspections or certificates specific to structural soundness, safety, or habitability. Chicago has a life safety evaluation code where projects need to register and have a health safety evaluation completed. If they have not done that in a timely manner, this would be a violation of state or county jurisdictional mandatory inspections. So if they haven't gotten that inspection, it could lead to issues proceeding with loans in the project. Violation of code violations, or any type of litigation that an association may be involved in because they did not pass an inspection, is also pretty prevalent in that area as well. So we have to look for those. It's a question that is asked on most condo questionnaires and is addressed sometimes in meeting minutes. So we need to make sure that the project is code compliant if there's been any inspections. We're not asking the associations if they know the project is code compliant. We're not expecting managers or anyone to walk the property and say, our electrical is not up to code. That's not what we're looking for. We just are looking for any communication that the associations have been notified from a local authority that their project is not code compliant. The next bullet point here is any unfunded repairs costing more than $10,000 per unit. This confuses, I think, a lot of people because unfunded repairs costing $10,000 or more per unit, what Fannie Mae and Freddie Mac are referring to are unfunded repairs. This is a situation where they know they need the repairs and they have not yet obtain the funds to do so. If they have the funds in their reserve account, or if they have the funds available by way of a special assessment, that is not a component that we're concerned about. We know there's repairs needed and we don't know how we're going to get the money, essentially, is what this bullet point covers. Examples of some of the items to consider. These are the items that we're looking at for all of these terms that we've just covered. We're looking at seawalls, elevators, waterproofing, stairwells, balconies, foundation, electrical system, plumbing, water intrusion, parking structure, other load-bearing structures, and then roofs, of course, is a component of that. Exterior elevations and siding is also something that we're looking at. In Chicagoland, there are a ton of projects that have parking structures underneath the buildings. That is definitely something that we see. If the parking structure is leaking or there's any material deficiencies within the parking structure, it will affect the project as well, even if the association doesn't own it, because they have a responsibility to the maintenance costs for that. So that covers what I got on this slide. Dan, is there anything else?
Yeah, because this is probably the most critical piece, right? This is the big change from what we've been doing forever, right? And we here in my office, we just ran into this situation in a Tinley Park complex, Cambridge Place. It's huge, lots of units, and they have a major issue with the balconies. Not everybody's balcony, right? So when we were first getting into this, it happened that we were able to deliver these loans because we still had a Fannie Mae approval on it. But going forward, until the work is done on the balconies, that condo complex is now not financeable because that approval with Fannie Mae has expired. So they were in the midst of getting the work ready. And, the question the agents had on the one, we did 3 in the last 6 months. One of them, was, well, wait, our unit doesn't have any issues with the balcony. Well, it doesn't matter about the specific unit. It's that there was a $80,000, I believe, assessment for this. This was a big structural and hazard issue. And there were stairwells involved also. And it may not have been in the one building that maybe your unit was in, but it affects the entire HOA. So, it is going to start. You're going to see more of this. And, the more we can do due diligence up front. And that's why in the invite, we sent you the typical condo questionnaires. I also sent you the deferred maintenance and special assessments questionnaire, so you could get an idea of what is being asked for. The difference between limited review and full review would be basically anything with typically less than 10% down is going to be a full review, or anything with 10% or more down is going to be a limited review. Okay. But as far as the deferred maintenance piece, that's still going to be required no matter what type of review we're doing. So I want to take, right now, pause. And if there's questions, please, unmute yourself, type them in the chat, because this is something we're going to run into on more than a few condo complexes in our area, especially if you're working in the city, because a lot of those buildings are even older. So if anyone has any questions, go ahead and unmute and ask them, and Amy and I will try to answer them. Okay, you did a good job, Amy, I guess there. So, but if you do have any at the end, we can cover them all. Okay, so we're going to go to the next slide, because I think this is probably a really important slide, because there's a lot of common misconceptions about approvability of complexes and information that, to be very honest, not all loan officers know the guidelines very well. I mean, condos are tricky. There are a lot of different rules involved with them. And I can tell you that, as a manager here at Guaranteed Rate, I have over 70 loan officers that work for me. I would venture to guess that maybe 40% of them don't know some of these basic rules or misconceptions you're going to see on the next slide. Amy will go through those with you, and then we can take some questions at the end, okay?
Great. So common misconceptions that we see in the Guaranteed Rate Condo Department, I handle a lot of scenario questions. And a lot of those scenario questions are coming from loan officers that are relaying questions from realtors and asking about different projects. Hey, this lender can't do this loan because of this. Are you able to do it? And so some of these come from that. So rental concentration is a big one. I can't tell you how many loans we've done that other lenders were either confused or did not know about the guidelines. But Fannie Mae and Freddie Mac do not require a minimum owner occupancy for all condo projects, right? The owner occupancy only comes into play where we have to verify that 50% of the units are owner occupied is for a new condo project or for a full review of an investment unit. So if you have an investment unit transaction and a full review is required, then we have to verify owner occupancy. But investment units can qualify for limited reviews, and under limited review guidelines, we don't have any owner occupancy requirements. So that's a big one. And we need to find out limited versus full, but I wouldn't immediately go to, oh, there's too many rentals, we can't do a loan in this project, because it's not the case. So that's a big common misconception. Single entity ownership. There's been a lot of guideline changes about this over the decades that I've been in the business. And it used to be 10% single entity ownership. It's not anymore. And Fannie Mae and Freddie Mac have different requirements. So for a single entity ownership in a project that consists of 5 to 20 units, a single entity can own up to 2 units and it's still eligible. And then for projects with 21 or more units, Fannie Mae allows a single entity to own up to 20% of the units in the project, and it's still okay. Freddie Mac allows up to 25% of the units owned by one entity, and it would still be fine. In addition, both Fannie Mae and Freddie Mac allow us to go up to a 49% owner or single entity ownership under certain circumstances. So if the subject unit transaction is the purchase of one of the single entity owned units, so let's say the developer still owns a chunk of units in the project and they're trying to unload them, they've been renting them for a while and now they're trying to unload those units. If your buyer is purchasing one of those single entity owned units, then we could look to see if we can allow up to 49%. There can't be any pending or active special assessments within the association, and the single entity has to be current on all their HOA dues. And then we have to verify that their intention is to reduce their ownership in the project to bring it down to Fannie Mae and Freddie Mac requirements. So we've been able to get quite a few loans done that way, especially in a situation like I described. The developer retained units within the project for rentals for a number of years, and now they're trying to unload them. So we've been able to do that. Litigation is a scary thing to see when you get a condo. And there's a lot of misconception that litigation just stops the deal in its tracks, and it's not the case. Litigation, actually, I would say I probably approve at least 80% of litigation cases I see, if not more than that, just off the top of my head. The existence of litigation does not automatically render the project ineligible. However, there's a couple types of litigation that we do run into issues with. Litigation involving repairs for defective work, that's going to be a problem. Or insurance claims could be a problem. Not always insurance claims, but if you have an association that has filed notice to the builder or has filed formal litigation against a developer for construction deficiencies, that's going to be a pretty big problem. We reject almost all of those unless we have verification that the association has corrected the defects within the project. When the association sues an insurance carrier for not paying out a claim, if the repairs are 100% complete, we're usually okay with that. But if the repairs are not complete, we might have an issue. Even if litigation is not formally filed, pre-litigation activity still must be reviewed. And an example is that notice to builder, which is what has to be filed before formal construction defect litigation has to be filed. In some cases, also what we find for pre-litigation activity is cases where an attorney has reached out to the association on behalf of one of the unit owners for, say, damage, and they're saying, hey, we have this issue, help us, or we're going to file suit. That would be considered pre-litigation activity. Or if the association has filed the claim to their insurance, but they haven't made a decision yet on coverage, that could be pre-litigation activity. We have to review it. Most oftentimes, pre-litigation activity, except for construction defects, don't really pose too much of an issue, but we still have to take a look at them. Other common litigation is personal injury lawsuits, which are generally approvable. Personal injury is someone walked through the association, tripped and fell, and they're filing suit against the association for personal injury. As long as the association's insurance carrier is defending that lawsuit and the damages are likely to be covered by the insurance company, we can usually get those approved. Some other types of litigation that we see that are really not a big deal are unit owner disputes. One unit owner suing another unit owner for noise, or their bathtub overflowed and caused damage to the ceiling of the unit beneath it. Those are unit owner disputes. Those aren't typically much of a concern for us as long as we get documentation to show compliance with guidelines. We also see non-monetary lawsuits, the unit owners suing the HOA because they either didn't give them notice of a board election or they didn't agree with a budgetary item or something along those lines, and it's non-monetary. We don't really have any issues with those either. So litigation, in a nutshell, we just need to take a look at it. If you find out that an association has litigation pending within it, then let's get a copy of the complaint. We can find that it's public record on the court website, and we can get a copy of it downloaded if that's the only way to get it. And we just have to take a look at it, and then we can advise what's needed to get in front of that as soon as possible. And then insurance. I covered that already a little bit about deductibles. insurance has to be reviewed. In most cases, insurance can't be completely reviewed without an entire project review because we need to know how many units are in the project and there's some details that we need to know. But condo master insurance must have replacement cost. It's for attached condo projects, that's required. The property coverage has to be at replacement cost. If we have coverage listed at actual cash value, that's going to be an issue. Actual cash value essentially is a depreciated value, and it's not acceptable to almost all investors. We have to check that. Deductibles can't exceed 5% of the face value of the property policy. If there's co-insurance, we're going to need to do some extra work on that. We need to verify 100% insurable value is provided in coverage. And we need additional documentation from the insurance carrier, and that takes some time. Sometimes it takes a little bit of time to get with the insurance agency and have them pull replacement cost estimators or project appraisals. We cannot have the insurance exclude building ordinance or law. That's a required coverage. We need to make sure that that's covered. And then it must have sufficient liability and fidelity bond coverage. That's only under full reviews when you only have a small percentage down. We need to make sure that liability and fidelity is compliant with guidelines along with the property insurance. So we just need to get in front of those insurance certificates as soon as possible, as I've discussed in the other slides. The more information we have up front, the better. The more information that we have earlier in the process, the quicker we can make a decision and get in front of any obstacles.
It's great, Amy. Great stuff. And, I think kind of going right back to the beginning, right? Especially speaking more from the listing side of things, when you're having that conversation, we're about to list the property. Give me everything you have on your HOA. Do you have a copy of these items, right? I mean, if you can gather up some of that, you're going to make it a lot easier for whoever the lender is that's going to work on the loan for the prospective buyer. And again, if there are any questions you ask of them where you do have some concerns, whether it's litigation or there's repairs being done or anything along those lines, we're here to help. I mean, that's the reason I put the call together. I just think that, personally, I've had 3 condo complexes just in the last couple months that have had huge deferred maintenance issues. And the 2 of them, unfortunately, there was no way to get them done. What was involved was extremely, hazardous structurally. And the next question is, well, where could they go get a loan? These days, most banks don't want to do things that they're going to be stuck holding on to a loan, and potentially in a complex that may have a huge risk hazard situation. That one of the complexes, I mean, I don't know if that person would be able to sell it to anybody that was going to secure financing, because even you've heard the word non-warrantable. We do have investors that will do non-warrantable condos, but they're not. Those guidelines are changing also, and aren't certainly for situations that are going to present a health or hazard risk that even the lender, if they knew about this and they let the buyer close on it and something happens, we could be liable also. So there's a lot of liability issues with all this, and that's why I think Fannie Mae and Freddie Mac have stepped in to try to level the playing field, make sure all lenders are complying the same way. You got I would say 80-90% of conventional financing in our country ultimately will be sold to one of these 2 agencies. So most condos are going to have to fit within these guidelines. So any questions, anything, you would like us to address before, we part ways? But I appreciate everybody jumping on, and I'll allow a minute or 2 to answer any questions.
Hi. This is Susan Brandt. I'm sorry, I kind of missed what you said. Dan, I worked with you on the Cambridge one.
Yep.
That we had issues about getting.
Yep.
I'm sorry. So tell me again now, what's going on with them? I know it was the whole balcony issue that we had.
Correct. It was there. So they've got
going to be. Yes. I'm sorry. So I kind of lost you when you guys were talking. So are they going to be able to be financed?
Until that work is going to be done in there, and they were beginning that process, they are no longer going to be able to get typical regular conventional loans, because we had there was a master approval. I think it was Fannie Mae still had it on their system, but now that there's this issue, and the way there's a repository of information now. So if you have a listing in there, Sue, and let's say Loan Depot goes and buyer applies with Loan Depot and they request all the condo documents, and that association has to fill out the deferred maintenance questionnaire. Well, they have to mark yes. I mean, there is a major deferred maintenance issue there. Well, as soon as they review that, that is no longer going to be able to fit within the normal conventional guidelines.
A lot of condos, there's a lot of places up in that area right now.
Yes.
Crazy.
Yep. Yeah. And one of the questions, we will be sending out the recording of what we did here today too, so that we have it. But yes, that's why I wanted to have this call. With what we're seeing, it's and I wish that there were 800 agents on here, because it's the other 775 that are going to go out and list a condo, not ask any questions. You get a buyer all excited, ready to go, and we get the questionnaires in, and there's roof leaks or structural issues or mold, things that we just didn't have to dive into as diligently as you do now, and deals are going to unfortunately not be able to close in some cases. Anybody else have any questions at all? Well, again, we appreciate everyone jumping on, and we'll send out to everyone the recording of the video, and you should all have the documents I sent. I think they're really good. Not that you need to have them filled out or anything along those lines, but I think it's important for you to just get a gauge on what is involved. And in many cases, when you're dealing with the HOA, some are self-managed. I mean, those can be really difficult, because there's one person that's in charge of filling them out, and they have a full-time job, and trying to get them to do it. So getting your seller engaged too, that they're going to need to, we're going to need these documents because the lender's going to need them. Who is the point of contact? Why don't you already start working on the budget and the insurance? They should actually have copies of all that, because they should be provided that on an annual basis, or they can receive copies of it. So I think doing more homework up front for all of us is going to make this a better process. And as Amy said, because of what happened in Florida, there is a lot more proactivity happening than what was happening in the past. I don't think any HOA wants that liability on their hands. And then one last thing that right back in the beginning, Amy said, the name of the HOA, that is not the address of the property. Okay. So, the name of the HOA, I mean, like Cambridge Place. Well, they're not on Cambridge Place Street. There's, Drummond, and there's a few different streets. So there's a name for the association. The legal name is what we use to look them up and to make sure, what we reviewed or what we've not reviewed. Okay. In Chicago, it can be a little tricky, because some of them may be the address of the property as the legal name. Some have an actual name besides that. So, that's something that you need to make sure that and to be honest, if you're listing a condo, put it in the MLS information. That's really helpful, because when I run numbers for one of our buyers, we're going in there, and if we see the name of the HOA, I can look it up to see if it is FHA approved. I can look it up and see if it is VA approved. I could look it up on our condo checklist or our condo list and see if we've done any work in there. So providing the name of the actual HOA in your notes, or there's a spot that says that in the MLS, is very helpful to the prospective lender on the other side. So definitely hope that helps. And, we'll look forward to answering other questions you have and helping you out with deals down the road. All right. right. Well, no questions. And I appreciate everybody for joining. Again, Amy, thank you so much for taking time out of your day. It was very informational, and we'll hope to catch everyone down the road. Okay. Take care.
You're welcome,
everyone.
and thanks for having me, Dan. And if anyone has any questions and you want to filter any condo questions through Dan, I am more than happy to look at scenarios for, possible projects or anything. I'm available. So Dan, I hope that helps and helps everyone else.
Fantastic. All right, but everyone, take care and have a great rest of your day.
Thank you.
Bye.